Good morning, everyone. So, today we will understand what is the solvency ratios. So, solvency ratio and their types. So, first, let's understand what is the meaning of the solvency ratios. So, solvency ratio by name you can understand that here management or outsider wanted to make it sure that whether the position of the business is correct or not. So the main purpose of these solvency ratio is basically to identify by the lender or a money provider. So you can say that a person who give advance money to the businesses on long term basis mainly interested for their periodic payment of the interest as well as repayment of the principal amount. So the lender here you can say that banks or the person who give advance to the money. Okay, so you can say the bank or lender normally calculate or you can say observe solvency ratio because they wanted to know the correct positions of the businesses in which they are going to put the money. Okay, so number one thing is that, so here what is their purpose? They wanted to make it sure that their interest as well as their principal amount will be safe or not, and that is why. So this formula is to calculate. So basically first let's identify that how many types of the solvency ratios are there. So solvency ratio again divided into five parts, five types of the solvency ratios there. Number one is debt to equity ratios. Debt to equity ratios, and then debt to capital employed, proprietary ratios, total asset to debt ratios, interest coverage ratios. But today we are going to discuss only debt to equity ratio. So the debt to equity ratio formula is here long term debt divided by shareholder fund. Equity means shareholder fund. So as we discuss here, long term debt we will take. Long term debt means non current, whatever portion of the loan coming in the non current portion we will cover over here. Okay, and shareholder fund, what do you mean by the shareholder fund? Shareholder fund means everything: share capital, reserve surplus, money received against share warrant. So everything we cover over here. Okay, so if in the balance sheet, if someone says that what is the shareholder fund, so here non-current asset comes, here current asset come, here current liability come, here non-current liability come, and then equity come. So we are talking about this portion. Okay, so directly you can take this total or complete amount minus these two amount. If you reduce, then your equity will come. So that's how you can calculate. So in the long term debt, if you divide by equity, then whatever the ratio comes, that will be your debt to equity ratio. So normally it is advisable that businesses should have 2:1 ratios. Okay, 2:1 is a sound ratio for solvency or debt to equity ratio. So here, if 2:1 means company doesn't have more outsider fund, so a businesses consider more risky when the equity is less while bankers loan is more. So it means that businesses is completely depend on the loan, and in the future if something you know do not go as per our expectations, as per management expectations, then the businesses won't able to repay that amount, and that is why it is considered more risky. So it is advisable that your equity portion should be more, equity portion should be more. Okay, and your loan should less. this thing you can actually see in your practical life as well. If you guys anyone having more personal loan, home loan, then you can relate this question to yourself as well, because loan is something where you are not able to find yourself as a secure person. If you do not have any debt, outside debt, bankers loan, personal loan, then you feel very safe. And in personal, if we talk about, then you will able to take sleeps very well. So that's how we completed. So debt to equity purpose, you already understand that here the ultimate purpose of outsider money lender or money provider to identify that in businesses what is the portions of outsider loan compared to their equity. If loan is higher, it means that businesses is more risky. If loan is lesser, it means that businesses is in the sound positions. So that's a very simple logic. That is management, or here management do not want, but outsider wanted to see in any of the balance sheet. Okay, and that is why when management prepare their balance sheet, then they also considered, because they know that outsider will consider this debt to equity ratio first. If they find it very risky, then again it's a bit difficult for them to get more money from outsiders. So this is how we have today completed debt to equity ratio. So tomorrow we will cover debt to capital employed ratio and their meaning.